I'm Mike, and I'm the Chief Investment Officer here at Lighthouse Financial Services. I'm here with another monthly market update for you. Let me share my screen. Okay, and let's get going. March 14th, 2023, big week. And I'm going to explain to you everything that's changed over the last 30 days. And then there's a lot. So here's our talking points for the day. We're going to go over inflation in the economy, and the basic story is that since the beginning of the year, data has been coming in hot, meaning the economy's in a little better shape than I think most people expected, given all of the Fed-generated headwinds, higher interest rates, so forth. We have China coming back online, reopening, and Europe just hasn't fallen apart. So it's not just us. Inflation is falling, but it seems like we're not making as much progress as we did last year. It's certainly not falling fast enough for the Fed. Talk about that. And of course, the job market remains really tight, and that makes the Fed's job a little harder. We'll go over Fed and the interest rates, and this is really where it gets real. We'll talk about the failure of Silicon Valley Bank. That happened just this past week. Talk about the salient points there, and then what are the implications going forward. And I think the main implication here at the bottom of the screen is that the market is now on alert for some type of recession again, after several months of thinking that we were going to have, more of a soft landing or no landing. So let's get into it. Path of inflation, you've seen this chart before. This is the consumer price index in black versus the core consumer price index, which excludes just food and energy. They're a little more volatile usually, so sometimes economists want to get at sort of the underlying inflation in the economy, and so they'll use the core. You can see the improvement, right? Since last summer, it's very clear, but CPI is still at 6%, and I think the hope was that by now we'd have a 5 handle or something. So part of the problem, as you know, is that although goods like furniture, apparel, appliances, those types of prices have really come down a lot. Services, not so much, and we talked about this last time, how airfare, childcare, auto insurance, those inflation rates are still pretty elevated, and one of the key ones is rent. So the idea in the CPI of rent is a little different than you and I would think about it, and it's lagged and it's got some problems. I call it contrived, but nonetheless, that's one of the things that's keeping CPI elevated. Another main factor, I think, in the Fed's disappointment is that the labor market remains really resilient. And so you can see that what they call the U6, or the underemployment rate, in red. That just includes everybody who's looking for a job who doesn't have one, plus people who say they were discouraged, quit looking, and people who say that they're working part-time in lieu of a full-time position, which they can't find. So that rate is 6.8%, and I will tell you that is the sort of generational lows, and so it's considered very low at the moment. There are more job positions in filled job positions in the U.S. now than there was before COVID, and yet, what did we lose? 1 million people? And I think I'm hearing that a number of people retired early during the COVID era. So for whatever reason, we have a structural shortage in labor. And there's some reason for hope that maybe some people are being drawn back into the labor force, but it's still not solved. The other line here in green is average hourly earnings. And this is the other line that doesn't fit with history very well. And you can see, going back 2012, 2013, 14, that wage growth was about half of what it is now, at about 4.5%. It's come down certainly from last summer, but still some more wood to chop in the eyes of the Fed. So the Fed takes a look at all this and says, gosh, we have to solve this imbalance or we won't get inflation to come down like we want. So that's why they've been raising interest rates. And just this, nobody points this out anymore. There's so many other things to look at, but just a little piece of evidence that the economy really does remain pretty resilient. This is a measure of economic growth. They call it gross domestic product or GDP, but it doesn't matter. It's a measure of how fast economic activity is growing. And this specific chart is just a forecasting tool used by the Atlanta Federal Reserve Bank to try to figure out what is the first quarter of 2023, what is the growth? And that's been trending up. Right now it's a little over 3%, which is ridiculous. That 3% is beyond what the Fed would consider sort of our normal growth rate, somewhere in the neighborhood of 2. So despite one full year of a lot of monetary tightening, a lot of constraining the financial system, the economy remains pretty resilient. So again, there's a tug of war between, hey, is this good news? I mean, yeah, if you're a worker, it's good news. But on the other hand, if you're the Fed and you're trying to calm inflation, not so much. All right, so let's get into the big event, which is the failure of Silicon Valley Bank. This is a price chart for the stock for Silicon Valley Group, the parent company, as well as the KBW Bank Index, which is just a mishmash of all kinds of different banks in the US. And you can see that they both absolutely tanked over the last week or two. And so we're going to get into why is that. I mean, the first thing you'll notice, and the red line doesn't continue as far as the black because, of course, Silicon Valley no longer exists as a publicly traded company. It's in receivership, and it's essentially stock doesn't trade, and it's being administered by the U.S. government. But the second thing you'll notice is that there's a lot of sympathy. In other words, a lot of other banks are going down in tandem with Silicon Valley, and I'm not sure that that's really that really makes sense. I'll tell you about it in a second here. So the failure of this bank sort of set off a chain reaction of events and in capital markets. And I want to talk about the bond market. You've seen this chart before, and I sort of label it Fed versus investors because the Fed funds interest rate that in orange, that's what the Fed controls, right? They're stepping interest rates up a little at a time in order to kill inflation. On the other hand, the blue line is capitalism. So these are bond traders trying to guess what's going to happen to interest rates in the near term. There's a big disagreement here. I mean, yes, they go up in tandem through most of 2022, but then the Fed keeps going and interest rates, in other words, market-driven interest rates are now falling. So what this tells you is that the Fed kind of wants to go higher, and investors are saying, I don't think you can. A massive drop like you see at the end of that blue line indicates that investors are getting pretty concerned that the Fed may have gone too far or will in the future go too far. What the market's essentially saying is that we're looking at a bumpy landing. The no landing scenario, which I talked about in our last update, that was looking like it was more and more a possibility, is being scratched off by investors at the moment. And even the soft landing doesn't look probable. So investor sentiment expressed in price action in the bond and the stock markets seem to be pointing toward a bumpy landing, which is essentially what we were predicting last fall. But you know, this thing is fluid, and we've seen a lot of changes, and so it's really hard to tell month to month how this is all going to play out. Case in point, Silicon Valley Bank failure was unexpected. And one of the reasons it was unexpected was that it wasn't a failure, a regulatory failure. In other words, bank management didn't violate their banking regulations set by the Federal Reserve. It doesn't look like there was any crime committed here, unlike, say, with if you read about Credit Suisse, who knows what was going on there, but that was more of a internal accounting errors and mismanagement sort of a thing. In this case with Silicon Valley, their failure seems to have been brought about by two factors. The first factor is that they were sort of a one-off, a very niche type bank where they did not serve a diversified set of customers. They were pretty much just serving venture capitalists and startup companies, which are high risk, extremely high risk, and which really took a hit when interest rates started to rise. That was one factor in their failure. The other factor was what the Fed has done with interest rates. They got sideways with the huge change in interest rates over the last year. And I'll kind of explain that a little bit. If you read my blog, I probably beat it to death a couple of times, but essentially management was tired of investing all these deposits that they received from their customers in short-term bonds because they weren't able to really produce much of a yield. Short-term bonds until a year ago were yielding close to nothing. So they made the decision, which was a change of their investment strategy, to invest in long-term treasury bonds. And long-term treasury bonds are very low risk. They're backed by the full faith and credit of the U.S. government. And so, from a regulatory standpoint, there's no problem with that. The issue was that they had invested these bonds in these long-term bonds, and their money was tied up. And when their customers started pulling out money at an accelerated rate from the bank, they had to figure out how to meet those withdrawals and expected withdrawals. So they made a very controversial decision to sell the long-term bonds at a loss, a nearly $2 billion loss, and reinvest in short-term bonds. And they figured, well, we'll make up that lost capital by issuing stock, and investors will buy our stock. We'll get back the $1.8 billion and we'll be whole. But there was a problem there in that investors and depositors started to sense some desperation there, and word got out that they were sideways, and that led to a run on the bank. Everyone trying to get out their money as fast as they could, and it failed. So in my view, the Fed has some responsibility here. We have to look back at the last year and say the pace at which the Fed raised interest rates was, if not unprecedented, very, very unusual. And I think the reason was because a year ago they realized they were behind the curve and they didn't want to lose control of the situation, and they really jumped in with 2 feet. I'll say, addressing the salient points here, this is not a credit crisis. This isn't what we had in 2008. This is more of a duration issue and a direct result of the Fed raising interest rates so quickly and so high. I'll say that Bank of America picked up $15 billion in new deposits in the last few days because of that, which should tell you that Silicon Valley is probably sort of a one-off. It is a niche bank. Bank of America is very well diversified and bigger. The next thing is, and we can't forget this, unlike 2008, government regulators responded incredibly quickly to this crisis, and they essentially have mitigated all of the risk to depositors, pledging to make everyone whole. And that's highly unusual. Typically, FDIC insurance only covers $250,000 per bank account. But in this case, the Fed, Treasury, and the FDIC combined to pledge to cover all losses, and they made funds available. I think they were available this past Monday, so very, very quickly, in order to just sort of subvert this spreading contagion and the fear. So in our view, now I'm going to move to implications. In our view, the Fed put is back. And what that means, it's just an investment term. What it means is that if something bad happens, somebody's going to come to the rescue. And that seems to be what's happened here. The Fed isn't necessarily interested in bailing out stock market investors like they used to be before COVID or during COVID, but now they are definitely interested and should be in maintaining financial stability. The next implication here is that it's hard to escape the conclusion that banks are probably in a defensive mode for now. They're going to tighten lending standards. Even if the Fed doesn't tell them to do so, they will. They're going to tighten lending standards. And anytime you constrict credit in the economy, you're going to get slower economic growth. So there will be a slowdown. I personally think the Fed should probably, in its next announcement coming up this month, they need to acknowledge their role, or at least the role of rapidly changing interest rates in the breaking of Silicon Valley Bank. And they probably need to stop tightening financial conditions. I don't see any way around that. But just back to the point again that this is not 2008. This is a quote by Mike Santoli this morning. He's a senior markets commentator, CNBC, very, very head on your shoulders kind of a guy. He said, there's not an aggregate capital deficiency out there. There's not some kind of trove of toxic assets like we saw on the Lehman Brothers balance sheet in 08. What we have right here is government bonds went down a lot last year. So we're not really waiting to unwind something that's a mystery. And that's key. Okay, there's a lot of uncertainty surrounding capital markets, bond market, stock market, where they're going. A lot of uncertainty surrounding how the Fed is going to deal with this. But the key thing here is that we're not waiting to unwind some wacky set of assets like collateralized loan obligations, some crazy made up, financial engineering stuff like the tokens on FTX's balance sheet that are sort of a mystery. We're not waiting for that. We're really dealing with the aftershocks of monetary tightening. So where does that leave us? Well, here's the S&P 500. We bottomed in October. Don't forget that. I think it's easy if you're just looking at headlines, watching the news, to assume that the bottom is absolutely falling out. In fact, it is not. So we bottomed in October and rallied, had an especially good January, which has now largely been undone with a not so good February and a terrible March. And as we've seen, I think the financial stocks are really paying the price. Interestingly enough, we're seeing interest now in tech stocks, which during 2022 were persona non grata. But on a day like today, when the market's down specifically because of risk to the financial system, Microsoft was up more than a percentage point. So I wouldn't characterize this as panic. This is the market push-pull. It's a tug of war. We're trying to figure out how to price in the additional risk of maybe another niche bank failing soon. So that's what we're trying to do, and it's a very fluid situation. But again, I really have a strong belief that most of the risk of a bank failure has been obviated with this Fed put. If the government's going to step in and make everyone whole, it's hard to see how there would ever be contagion. So here are some of our disclosures. Read them if you wish. I say thank you here for watching and for trusting us with your money, and we'll be back in a month to update you again.